The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, as global economic and geopolitical landscapes shift, investors are facing new challenges and opportunities. The changing influence of the United States, particularly its evolving foreign policies and economic strategies, is shaping markets across the world. From supply chain vulnerabilities to the shifting role of the U.S. dollar, the traditional dynamics that have long governed global trade and investment are undergoing significant transformation. So is the U.S. influence truly on the decline, and how should investors respond to this shift? How will these dynamics impact investment strategies and global asset allocation moving forward? Well, to find out more, joining me now is Steve Brice, who is the Chief Investment Officer at Standard Chartered. Steve, welcome back to the show.
Thank you so much. It's a pleasure to be here.
Thank you so much for joining us. Steve, given the current new U.S. administration, how do you assess the current shift in global economic power? Is the influence of the U.S. in global trade, finance, and security declining?
So I think the quick answer is yes. So obviously, we've had some significant developments in recent times. So obviously the Russia-Ukraine conflict, then the sanctioning of the Russian central bank, the shutting off of Russian banks from the SWIFT system, etc. I think that already to some degree had started the process, but obviously with the new administration coming in, that looks like it's just going to accelerate as we go forward. So the exact format of how that will happen is unclear, but it does seem to be very clear that it's going to happen. And one of the key factors here, of course, is that the US is becoming less reliable to its partners and allies. So the assumptions of free trade or the security umbrella or even financial aid now all up in the air as to whether you can rely on those. And I think that's going to change the way that people react to what's going on, and obviously increase the incentive for countries and regions to become more and more self-sufficient and less reliant on the US.
I see. Well, then how do you see the U.S.'s evolving foreign policy and economic strategy impacting the global market landscape in both the short and long term?
So obviously, in the short term, we just got an incredible increase in policy uncertainty. So we don't know exactly what's going to happen on the trade front. Are these negotiating tools? Or is this actually we're going to move to a permanently high level of tariffs from the US? I think it's probably different for different regions, but obviously that uncertainty is there. In the extreme, if this goes too far, you could see an increased risk of recession. So that's the sort of the short-term dynamics. But I think longer term, what the key questions are is what's going to happen to relative growth rates around the world. So obviously we've seen the US economy outperforming most countries, especially in the developed markets. And, that now is coming under increasing scrutiny, I think, depending on the policy response that we're going to see globally. Obviously, Germany has stimulated policy quite significantly. Are other countries going to follow suit? And does that change those relative growth rates?
I see. Then what are the key risks and opportunities investors should be aware of as the influence of the U.S. declines?
So obviously, in the short term, the key piece here is that volatility has increased. So that is obviously a risk, but it's also an opportunity. So one of the mantras we've been talking about is saying, okay, we should be looking at buying the dip. Now, obviously, exactly which dip to buy. Have we seen the lows for markets? I'm not sure it's 100% clear that we have seen. We still believe that the Trump put is in place for markets as a whole. So from that perspective, we feel that, we shouldn't overweight these factors, at least from a short-term market perspective.
I see. Then, Steve, how significant do you think the re-engineering of the global economic order will be in the context of rising geopolitical tensions and the re-evaluation of U.S. dominance?
So I think we'll look back and say this was not necessarily the turning point, but the point of no return maybe for the US. Obviously, we had Trump 1.0 and people were saying, okay, it was just one administration, and then Biden came in and everything seemed to be relatively back to normal. But I think now this is sort of saying, no, this is going to be an inherent feature of US policy making from time to time. And therefore, over a long period of time, I think we're seeing a seismic change in terms of the relative power and the US dominance, really ebbing.
I see. Well, now what this means for investors is that while we see trade deals are done in the short term, it probably implies that US exceptionalism continues. But over the long term, though, the world economic and geopolitical order could gradually be re-engineered. So, Steve, with the possibility of US exceptionalism declining in the long term, what impact do you believe this will have on investors' behaviors?
So for a long time now, we've been in a world where if we looked at long-term expected returns, US expected returns, US equity market expected returns were lower than we've seen elsewhere in the world, but then the US continues to outperform. And what that's resulted in is obviously an extreme valuation gap between the US and the rest of the world, particularly in equity markets. What we've really been lacking is a catalyst to change that. So to see a narrowing of those valuations, which effectively is an outperformance of the rest of the world. And we've seen a little bit of that so far this year. But I think it's probably a little bit early to say what we've seen in the beginning of this year in the first quarter as being the catalyst to change that long term. But obviously it is leading a lot of people to start asking that question, which was almost not being asked at all at the end of last year, but it is now being asked. So it is possible that we're on the cusp of a reversal of US equity outperformance, but we need to see how things develop.
I see. Then will we see more reliance on non-US markets, thus shaping new global investment trends and asset allocation strategies in the coming years?
I think it depends to the degree to which countries outside the US see this as an opportunity. So one of the sayings in political circles is never waste a good crisis, right? As I mentioned before, we've seen Germany really take very strong steps from a German perspective that will add around 2% to GDP growth on an annual basis going forward. So, from a pure German perspective, we've seen dramatic action already. But the rest of Europe looks a little bit more meager. Obviously, China is trying to do something as well on the fiscal stimulus side, trying to keep that 5% target. But typically, they've underperformed in terms of the government expenditure or budget stimulus. I think there will gradually be less reliance on US markets. I'm not sure how quickly that's going to take place, given that we're not seeing wholesale action from all of the countries in the rest of the world, or even the majority on a GDP-weighted basis.
I see. Well, for over a decade now, Steve, long-term expected returns have been higher for non-U.S. equities, and U.S. equities have outperformed regardless. So with the potential rise of non-U.S. economies, what indicators then should investors focus on when, reallocating their portfolios?
Yeah, I guess there's, some long-term factors that we should be looking at, and then some short-term factors. So from the long-term factors, the growth differentials, as I mentioned before, that's really key. If we start seeing a structural reevaluation of growth prospects in non-US countries relative to the US, that's a key driver of relative performance. And also on the tech side, the technology side. So we've obviously seen the DeepSeek revelation earlier this year at the end of January. If we were to see more of that taking place elsewhere in the world, not just in the US, again, that would be something would be very interesting. And we should remember that the military is often a source of innovation. So with Germany, spending more on military going forward, they may well get the side benefits of technology. In the short term, I think earnings growth picture is going to be important, and we've certainly seen a bit of US earnings growth expectations falling and rising elsewhere in the world in recent times, and then the dollar outlook as well. So if the dollar weakens, that generally is good for non-US equities, or better for non-US equities than it is for US equities.
Right. Well, how would you then recommend diversifying investment portfolios to protect against risks associated with the US economy while also capturing opportunities in emerging markets?
So, not surprised to say that diversification is always important. Obviously, when you get situations like this, it becomes even more important. Nobody knows how this is going to exactly play out in the future. So, if we look at our balanced asset allocation model, we have a 17% allocation to emerging market assets generally. And also we have a 6% allocation to gold, which we see as a hedge against some of the geopolitical tensions. And also a view that we'll see central banks continuing to buy gold. So we see gold trending higher. If you're focused on income generation, then you're probably looking at an over 20% allocation to emerging market assets, just because bonds in the emerging market space offer significantly higher yields than those in the US.
I see. Well, on that note, how should investors then reassess their exposure to U.S. assets, especially equities and government bonds?
Yeah, I guess we don't think that investors should necessarily panic at this, right? So obviously there's a lot going on, and we do see a lot of negative news coming out and negative policy surprises from a market perspective. But we do believe that Trump put is still in place. So we still believe that U.S. equities will deliver positive returns this year. It will be a bumpy ride, but maybe from that perspective, buying on dips makes sense. As far as government bonds are concerned, we're moving actually underweight government bonds, but that's really shifting to credit. Our central scenario is the U.S. economy will be in a soft landing this year. That should be good for investment-grade credit and high-yield credit to outperform.
Well, are there any other sectors or asset classes outside the U.S. that also could, become attractive for investors looking for strong growth potential?
So, we mentioned technology earlier, so we're overweight technology within Europe, China, and India. So we see those as very strong places that have significant government support and obviously, a lot of development going on in the private sector as well. Within Europe, we also like the industrial sector and bank sector. So we see this stimulus from Germany over time really feeding into the broader economy and helping to support those sectors as well.
I see. And before we let you go here, Steve, what types of assets or investment vehicles should investors consider to, hedge against the risk of further geopolitical uncertainty and market volatility?
So we've obviously already talked about gold, but other areas I think, there are natural areas are, the yen, having an allocation to a yen can be very helpful in a risk-off scenario. So, and then obviously we've got policy in Japan being supportive of the yen with interest rate, them being in an interest rate hiking cycle, and wages coming through are just going to keep pressure on the Bank of Japan to continue hiking rates, in our opinion. Having some cash on the sidelines to be able to buy on dips as well is obviously a strategy that can be well employed in this environment. And then the final piece for those that have access, private assets, whether it be private credit or private equity, can really help diversify returns and deliver strong returns in the future as well.
I see. Well, thank you so much, Steve, for joining me today.
Thank you so much, Hongbin.
Thank you. That was Steve Brice, Chief Investment Officer at Standard Chartered. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.